Okay, excellent. In the last two sections, we've been studying two of the balance sheet items in more detail. We covered trade receivables and inventory, two asset accounts that are part of a firm's working capital. The third component of working capital is trade payables, and that's a topic we'll address later when we examine liability items. Starting from this lesson, we'll focus on a company's long-lived assets, also known as fixed assets. There can be three main categories of fixed, long-lived assets. Tangible assets, assets of a physical nature, plants, vehicles, and so on. Intangible assets, assets that are not physical. And financial assets, shares of subsidiaries or other securities held by a company. We will not examine the treatment of financial assets, as it requires specific competencies, and most of the time, it is not part of a firm's operating activities. Okay, whenever we talk about tangible or intangible assets, we must make an important distinction. The expenditure on these assets can be capitalized or expensed. Similar to what we had before when discussing inventories, the logic is that costs related to the building up of the asset, its creation, should be capitalized and therefore depreciated or amortized in multiple years, given that the asset will be used for multiple years. Costs related to maintenance or insurance costs can be considered period costs and are expensed when incurred. It is quite important to understand and perhaps repeat the implications of capitalizing versus expensing. When we capitalize the costs we sustained for an asset, we are moving these expenses to our balance sheet. So, naturally, our assets increase. The net income for the current year will be higher because we are not expensing everything in the current year. For the next few years, we will be expensing a portion of the overall costs sustained for the asset. So the other consequence is that net profit for the current year is higher. The third important implication is related to taxes. In most jurisdictions, if we capitalize an asset, we postpone its deduction as an expense and therefore pay higher taxes on corporate income. Great. So, depending on the context, it could be more beneficial for firms to capitalize or expense their fixed asset expenses. Sometimes it is possible to choose how to represent certain costs. If a company prefers to capitalize costs, it is interested in appearing more profitable, which is very important for listed companies. If a firm tries to expense the entire amount, then this probably means it is interested in paying lower income taxes in the current period. In our next video, we'll talk about capitalizing interest expenses. Thanks for watching.